Hi, today I'm going to talk about the third important macroeconomics mechanism that GC students should actually try to internalize it, which will help them to prepare for the A-level exams more effectively. So in my previous two videos, I actually talk about the two macroeconomic mechanisms. Number one is the investors' confidence mechanism. So this is really very important because almost everything is linked to investment. It is very highly unlikely that a student can go through a whole macroeconomics paper without talking about investors' confidence. The second mechanism that I have introduced in the previous video is what we call the exchange rate mechanism. How changes in exchange rate will affect the economy in various areas, primarily in the area of net exports and imported inputs. The third mechanism that students should actually try to internalize is the interest rate mechanism, which I will expound on it in this video. Now, as I said, these two are known as the monetary policies of a government. So when a student learns the exchange rate mechanism and the interest rate mechanism, effectively he or she is actually revising monetary policies. So let's get it started. Whenever we see anything that relates to interest rate, straight away we'll break it into two branches. We break it into the cost of borrowing, and we break it into the rate of return on savings or deposits. So for example, let's say a government adopts an expansionary monetary policy. They decide to lower the interest rates. When interest rates are lowered, the cost of borrowing is lowered. So therefore, assuming all things stay the same, there's an increase in borrowing. And generally in JC Econs, people borrow to do two things. Okay, they borrow to either invest or they borrow to consume. Okay, so ceteris paribus, when investment increases, consumption increases due to a drop in interest rate because cost of borrowing has dropped. Okay, I call it COB from now on. This will lead to an increase in AD, and then from there, you can actually link it to various macroeconomic aims. Now, at the same time, the rate of return on savings or deposit also goes down. Always remember, interest rate is known as cost of borrowing to the borrower, and it is known as the rate of return to the saver. Okay, so now the interest rate in the bank has dropped. So assuming all things stay equal, ceteris paribus, it leads to a decrease in savings. When people save less, generally they will consume more. Okay, and when they consume more, AD will increase. Okay, now at the same time, okay, this is a more confusing part which a lot of GC students actually missed out. So it'd be good to remember, when a rate of return on savings goes down, it will lead to an increase in outflows of hot money. Okay, now let me just explain this concept about hot money. Basically, hot money, it is just a term that describes very liquid assets, meaning that it is very easily transferred to and fro, especially in the area of cash. So for JC Econs, when we talk about hot money, we are mainly talking about currency flows. Okay, we're mainly talking about currency flows. So how does interest rate actually affect hot money? So for example, when I have, let me just use a different color just for variety, okay? Now, so for example, when I have that two banks, okay, one is DPS and one is maybe Citibank. Now, in Citibank, they pay 3% interest rate, okay? Citibank is a US bank. So when they say that they pay a 3% interest rate, this 3% interest rate is actually tied to the America's interest rate. So this is mainly the interest rate on US dollar deposits. Okay, US dollar deposits. Now, just assuming that Singapore, okay, at the beginning, it also has a 3% interest rate on Singapore dollar deposit, okay, SGD deposit. In the year maybe 2017. Okay. Now assuming in 2018, okay, the US Central Bank or the Federal Reserve decides to increase the interest rate from 3 to 4%. Okay. So what happened is that, assuming all things stay the same, Singapore savers or people who hold on to Singapore deposits, they'll be thinking like, hey, you know, if I put in Singapore deposit, I will only earn 3% interest in 2018, assuming there's no change. But if I put in a US deposit, okay, a US deposit, I will actually earn an extra 1%, since 4% is more than 3%. So assuming all things equal, Singaporeans or people who hold on to Singapore money, they will decide to exchange, okay, they will exchange Sing dollar and demand for US dollar instead. Okay, so they don't want Sing dollar, they want to have US dollar, to put the US dollar into US dollar deposit to earn this extra 4% interest. So can you see that when there's an increase, okay, when there's an increase in interest rate, it leads to an increase in demand for US dollar. Remember I told you that hot money is currency flows? So now there's an increase in inflows of hot money into the US dollar market. Okay, they want to demand for US dollar. At the same time, there is a increase in outflows of hot money out of the SGD market. Okay, so this is how interest rate differentials or how interest rate changes will affect currency flows in the area of hot money. So hopefully this will help you students to be able to better appreciate how interest rate affects flows of hot money. Okay, so let's go back to the original diagram. So when interest rate goes down, it leads to an increase in outflows of hot money, assuming all things stay the same now. So outflows affect supply of currency. So it leads to an increase in supply of currency. And when there's an increase in supply of currency, assuming ceteris paribus, it will lead to a depreciation of the exchange rate. And then what you do is you then invoke the exchange rate mechanism. Okay, you invoke the exchange rate mechanism. So another rule of thumb is that if interest rate goes up, okay, so let me write here aside. If interest rate goes up, you will say that there will be an increase in inflows of hot money. Inflows affect demand of currency, so lead to increase in demand of the currency, and exchange rate will actually appreciate. Okay, and then after that you invoke the exchange rate mechanism again, which is in the other video. So effectively, this is what interest rate is all about. Okay, now what is the what do you call it? The factors affecting the extent of and drop in exchange rate to stimulate growth. So that's another topic in itself. Just a few clues. Anything that affect investment, the main thing that you can talk about that will influence the success of interest rate stimulating investment, you can actually talk about the level of investors' confidence. Okay, so how to talk about this investors' confidence? You can always go to my first video on the investors' confidence mechanism. So hopefully, to wrap it all up, okay, these three mechanisms, my encouragement is good to go and see all the three videos, internalize it, come up with your own flowchart, and it will help you a lot. It helps A-level students a lot in preparation for their case study and essay. Now, very typical questions will be like this in the case study. Like with the aid of a diagram, explain how QE will result in a weakening of the yen. This question is actually asking about how QE actually affects interest rates, and how interest rate will in turn affect exchange rate. Okay, so if you look at the answer, okay, so can you see when a government adopts QE by the Bank of Japan, they will start to print money. Print money, they will increase the money supply. Money supply goes up, interest rate goes down. You invoke the interest rate mechanism. Rate of return of the Japanese deposit or Japanese yen drops. It leads to an outflow of hot money. Supply of yen goes up. Ceteris paribus, exchange rate of yen depreciates. Another special question or typical question will be like this: how tight credit conditions will limit domestic demand. So tight credit conditions means interest rate might be high. So for example, you can look at here. Due to rising debts of Eurozone, there will be a decrease in central banks' willingness to lend funds. Okay, so that means that supply of loanable funds will drop, then it will lead to interest rate increase, cost borrowing increase. When you see interest rate, you think of two things: either cost of borrowing or rate of return. Okay, so that sums up for my video. Three mechanisms that I always encourage JC students to remember for macroeconomics: investors' confidence mechanism, exchange rate mechanism, and interest rate mechanism. So hopefully this video will actually assist students to revise more effectively for their A-level exams. Thank you.